The Bank of Japan has increased its flexibility on yield curve control, but it's kept interest rates unchanged. Let's take a look at what we saw out overnight. As widely expected, it maintained its negative 0.1% target for short-term interest rates, and that for the 10-year government bond yield around 0% set under yield curve control. But the Bank of Japan redefined 1% as a loose upper bound rather than the rigid cap. It also removed a pledge to defend the level with offers to buy unlimited amounts of bonds. It's also revised up its price forecast to project inflation well exceeding a 2% target for 2024, underscoring growing conviction that conditions for phasing out ultra-loose monetary policy are now beginning to fall into place. There's some speculation it could come by the end of the year. Inflation is staying above the Bank of Japan's 2% target for the 18th straight month in September. Let's take a look as what else is happening in the Japanese economy, because factory output rose 0.2% from the previous month against the median market forecast of a 2.5% gain. And retail sales up 5.8% in September from this time last year, marking a 19th straight month of gains and roughly in line with the median market forecast for a 5.9% increase. Now, all this positive news is all very well, but without more reasons to hold yen, we're seeing the yen fall again, pushing the dollar back up above the 150 level. And you can see clearly above that red dotted line, which takes us up there to these levels here. And the last time we were at that level, remember, October last year, we saw the Bank of Japan come in and defend the yen with a series of operations in the foreign exchange markets to support yen, and that pushed the dollar down. But we don't see any real appetite for the Bank of Japan to do it this time around.